Hi there, and welcome to the week ahead with me, Fiona Cincotta, Senior Market Analyst at City Index. On today, the 3rd of May, we'll be looking ahead to the week starting the 6th of May. Now, Monday, the 6th of May, which is a bank holiday here in the UK, but not in the rest of Europe or the US. So if I just give you one moment before we crack on to read through the risk warning. I'm just going to put myself on mute if you could just read through that briefly. Okay, so let's get going. As always, we'll just start by taking a look at the economic calendar. This is the economic calendar on the UK City Index website, and we've just filtered that by displaying for next week and also the high priority. So as we kick off on Monday, first up is going to be the Chinese cakes and services PMI. Now this rose in March to 52.7, and that was up from 52.5 in February. Now the market will be looking for sort of the upward momentum to continue, and basically, yeah, we're looking for the upward momentum to continue. If we just had an upward revision from the OECD this week for Chinese growth for 2024 was upwardly revised to 4.9% and 4.5% in 2025. And basically, this is sort of, as we're seeing support from fiscal stimulus and exports coming in and reviving the economy, albeit on a steady, slow basis. This week, we also had the manufacturing cakes in PMI, which came in with showing the strongest growth in 14 months. So there is some signs, although the official data from China was more mixed, showing slower growth for both the non-manufacturing and the manufacturing. So, it is slightly mixed, but we are expecting to see this very steady pace of improving growth in the world's second largest economy. Now, on the back of that, I always think it's quite interesting just to have a look at oil. We know that oil does trade generally, is influenced by what's going on in China, although the manufacturing PMI does tend to have perhaps more of an influence than the services PMI on oil. Data from China can be a good sort of guidance as to what we can expect on oil prices. And oil prices is a good excuse to look at oil. I mean, if we have a look at oil prices, they've fallen out of this the rising channel that they've been trading in over the past quarter since the end of 2023, fallen out of that channel, dropped below the 200 SMI and the 80 psychological level to find support, sort of currently around that sort of 79 level. Now, I think, if we also combine, we've not only got that sort of strong bearish engulfing channel, the breakout below this, the rising channel, break below the 200 SMA, we've also got the RSI supportive of further downside. So, we could see this still fall lower. I think, we could have a look, perhaps here is a level to be watching out for. That's the 100 SMA, but it's also a level which seems to have offered support and resistance across the board at around that 77.70 or 77.80 level, just around there, around 78 even. So if we could get a breakdown there, then that could actually bring this level down here, the 75.80, back into focus, the level that was quite important here in the middle of February. If we get a rise above the 80, the 200 SMA, that's going to be the key level that buyers are going to need to break above in order to get back into that rising channel and head towards the 83.10 level. So next up, we've got the RBA interest rate decision. Now, this is going to be a really interesting decision because, I mean, let's just take a look here at, this is the inflation picture in Australia. Now, I think the question here is, the RBA is expected to leave rates unchanged at 4.35% for a fourth straight meeting. However, there are concerns or expectations that maybe the next move by the RBA may be a rate hike rather than a rate cut. That's not to say that we're expecting an imminent rate hike, but inflation has come in stickier than expected. It came in at 3.6%, and that sort of bolstered these expectations that perhaps the RBA is going to adopt a slightly more hawkish stance. Now, I think they're going to adopt a more hawkish stance, but I don't think we'll be necessarily looking at a rate hike from the RBA at all. I mean, have a look at this chart. We can see that although inflation was a little bit hotter than expected, it's still cooling on the right track. It still seems to be on track to head towards the RBA's 2 to 3% target range. So I don't think they'd be, looking to hike rates at all right now. They'll want to see how this continues to play out, to see whether the economy remains resilient. Now, we are seeing a little bit of weakness come in some jobs data. Also, consumption is still weak, which could start to have a slowing effect on the rest of the economy and could help bring inflation that bit lower as well. So although we're not looking for any move from the RBI, just perhaps be wary of a slightly more hawkish sounding RBA governor than perhaps even last time. I mean, even last time they were a little bit more hawkish than previously. So what does all this mean for the AUD, for the Aussie dollar? So this is really interesting, the chart. Look, we've seen this recovery from the low here of 63.60. That was the April low, long lower wick, suggesting there wasn't really much demand for selling at these lower levels. Seeing this recovery, now the recovery is just attempting to cross this point here, which is quite crucial around the 65.80-ish level, because what we've got going on here is you've got the 100 SMA and you've also got this falling trend line, which is dating back to December, at the end of last year. So that's something just to be watching out for. If we get a move, sorry, actually, I think it's probably about there, in fact, isn't it? There we go. We're just testing it now. If we do get a move above there, then maybe watch out for this level here, which is the March high. That's at 0.6670, and above from there we can get the 67 level. So if we get a hawkish sounding RBA, then that could push the Aussie higher. Obviously, you do need to keep in mind about what's going on with the US dollar, but we'll talk about that shortly. On the downside, if we see sort of rejection at this level here, and we could see a retest of the 200 SMA around the 65.20 level. And below here, I'd be watching for this level here, which is sort of this zone, in fact, on the chart, which is sort of around from the 64.70 level to the 64.80 level. There's a zone there of support, and if we get a breakthrough there, then watch out for this one, the low here, the February low at 64.40. So they're the levels to be watching out for as far as the Aussie US dollar is concerned. So let's just have a quick look at what else we've got going on. So we've got retail sales in the Eurozone. Now this is interesting. The Eurozone is starting to show some signs of improving economic outlook, sort of an improving economic picture. Obviously, we had the downturn sort of at the end of last year, and it looks as if the Eurozone could be sort of moving out of that. We had GDP data from the Eurozone recently, which showed stronger than expected growth of 0.4%, which is an encouraging sign. We've also had some data from Germany that's tended to be pointing towards a more optimistic outlook as far as consumer confidence is concerned and business confidence is concerned, although the manufacturing sector in the Eurozone region remains relatively downbeat. With we had the PMI yesterday, it was down at 45.7, so you know it's still a really quite a weak picture as far as the euro, as far as the manufacturing sector is concerned. So let's just take a look here at what's going on in the euro US dollar. The data next week, the retail sales come as the OECD upwardly revised Eurozone economic growth to 0.7% this year, up from 0.6%, and with 1.5% growth expected next year, up from 1.3%. So again, highlighting the fact that the outlook is brightening, it would appear, for the region. Now we can see that euro US dollar trades in this downward channel. It has just picked up from the low of 106 as it recovers, and this will have a look on the dollar chart shortly, but this is also to do with dollar weakness here. We've seen that not only dollar weakness, but also sort of this encouraging signs that the economy in the Eurozone is starting to recover, although that's unlikely to deter the ECB and knock them off track from cutting interest rates in June, when they're signaled that that will be when the first cut will be. So I think what we're seeing here is some recovery on the back of the view that the Eurozone economy is not quite as bad as feared and is starting to show signs of recovery. Now, if we can get a break above this 107.50 level, which we're literally just touching now, that exposes the 200 SMA at 108, which is also a static resistance. On the downside, we're watching out here for 107. This is the low for February. So if we get a break below that, then we could also be looking at the 106.50 level, which was this week's low. And below that, we get 106 back in focus again. So like I said, it's quite interesting when looking at the euro US dollar and the Aussie US dollar to actually just take a look at the US dollar index to see what that's doing. And as we can see, we've had 3 straight days of downward momentum for the US dollar, and that's basically since we had the Fed meeting, which the US dollar is interpreted, or the market seems to have interpreted, as being slightly more dovish than perhaps what the market had been expecting after Federal Reserve Chair Jerome Powell sort of insisted that, or hinted that, the next move by the Fed will be a cut, not a hike, despite the persistent inflation. That's the message that the US dollar seems to have grabbed onto, despite the fact that rates will likely stay higher for longer. Just to be aware that this data, this is coming in ahead of the US non-farm payroll report, which hasn't been released yet. But there are a couple of key levels here. We're watching this US dollar sort of weakness at 105. That's going to be a key level, and that was the early April high. If we get a breakdown there, and I mean this has been sort of consolidating around this level, we've got a breakthrough below there, then watch out here for the 104.70 and then exposure of the 200 SMA there at 104.20. There are levels on the downside. Any recovery needs to get above the 106 level to bring 106.50 back into focus. Now, main event for next week, as far as I'm concerned, is the Bank of England interest rate decision. So here we'll get the Bank of England rate decision, obviously the vote rate, and also a speech by the Bank of England Governor Andrew Bailey. So, I mean, it's quite interesting as far as what to expect. No rate cut is expected in May. But I think there is a possibility that we could see a reiteration of that expectations. We could see the central bank reiterate that rate cuts could be coming soon. I mean, basically, we could see this as a sort of setting up for a June rate cut. I think, you know, we've seen UK inflation. Let me just bring up UK inflation for you. UK inflation, we can see it has cooled. So UK inflation is the black one. Obviously, it went higher than inflation in the euro area or the US. But it's fallen now, and it's fallen below inflation in the US. It's down around 3.2% currently. It's expected to fall quite sharply in April, given that we've got the downward revision for, or the lowering of the energy price caps for the UK. So that's going to bring inflation down further. With inflation cooling, the one thing to be wary of, I think, is service sector inflation, though, which the Bank of England has highlighted as being a hurdle for cutting interest rates sooner rather than later. Let me just pick up the chart for you. And we've just had actually the service sector PMI come in today. It was the strongest growth in 11 months, thanks to a rise in new orders. We did also see an acceleration in cost pressures, and that's basically due to the large rise in the national wage. But interestingly, companies appear to be reluctant to pass on this rising costs to the consumer in full, and that really suggests to us that perhaps service sector inflation then could cool. So I mean, it is proving to be stickier than what the Bank of England was hoping for, but there is a sense that it could also cool. Now, if inflation continues to cool as the Bank of England expects it to do, then we could be on track for a rate cut. I think June's probably a little bit early, but I would say August seems to be a potential rate cut. As far as the market is concerned, the market is expecting the Bank of England to cut rates twice this year. Now, that's interesting because that's a divergence from the Federal Reserve, which is only expected to cut rates once this year. And as a result, that's been sort of, you know, that weighed on the pound US dollar, pulling it down to this low here of 123. Now the price has recovered, as we saw that sort of, you know, expectations surrounding the US dollar have changed, and that's helped the pound push higher. It's been caught here between the, well, just there, the 200 SMA, but also this level here at 125.70, which is the weekly high, and 125 on the lower side. So yeah, if we can get a move above this 200 SMA and the 125.70 level, that's going to create a higher high, bringing 125.50, the 100 SMA, and then 127 into focus. Now, if the price faces rejection at this level, at the 125.70, then we could see a retest of the 125 level. Now, if we have a dovish sounding central bank, or a more dovish sounding central bank from the Bank of England, then we could see a test of that 125 level. US dollar, as we've seen on the calendar, is in short supply next week. So actually, it may not be the driving factor for the US dollar. Obviously, if there are Fed speakers hitting the airwaves, then they could influence the greenback, but data-wise, it does seem to be more of a focus on sort of, you know, the Bank of England or the ECB or the RBA, for example. So a bit of a break as far as US data is concerned after the big focus this week. So that's what to be looking out for. Whilst we're here, it's also worth taking a look at the FTSE 100. Also, I think the FTSE is a relevant one as far as the China data is concerned. Now we can see that actually it's risen to a fresh all-time high today, 82.11, 82.15. And it's basically, you know, if we see signs that the Bank of England could start to cut interest rates sooner, that's going to be supportive of the FTSE. Not only is that going to be supportive of the sort of retail sector, but it's also going to be supportive of the multinationals who benefit from the weaker pound exchange rate. So we can see here from the FTSE that it's really woken up. I mean, over the past couple of weeks, it's risen above this rising channel. It's hit, like I said, fresh all-time high of 81.15. RSI just tipping into overbought territory, so actually just it's worth being cautious because we could see a pullback. You know, as long as the price remains above 8,000, then I'm actually still bullish on the FTSE. It's going to take a move below 80,000 to create a lower low, and that could then bring the 79.40 level into focus. On the upside, as I said, dovish sounding Bank of England could see that price push on towards the 83 level. So what else have we got? We've got UK GDP. Well, we've just had a look at those as the FTSE and the GDP USD. Obviously, if we get stronger than expected data, that could be pound beneficial, and that could lift the pound, and it might have a diverse effect on the FTSE if we're seeing a stronger pound, and if it means less likelihood of the Bank of England cutting interest rates early. Then as far as US is concerned, as I said, you know, really short on data from the US. We've already looked at the US dollar. Let's just take a look at the S&P. Obviously, we've got earnings coming in next week as well. Earnings from Disney and Uber. They'll be the major ones to look out for from the US. Also, BP will be another one to watch for in the UK. If we have a look here, we can see this is the S&P. It's trading relatively range bound, caught between this level here, so around the 51.30, which is the 50 SMA, and on the downside it's trapped here. We've got on the lower side the 100 SMA at 5,000, and also the round number. So really we've got the RSIs at 50 neutral, giving away a few clues. Could be looking here for a breakout trade, a breakout on the outside. We're looking for a rise above that 151.30 level, and that could bring 5,200 into focus, ahead of that all-time high at 52.77. Now on the downside, if we start to get sort of, you know, here hawkish central bank speakers, then we might get a move below this 5,000 level, which is also the 100 SMA. Or if we get, for example, extremely weak consumer sentiment, we could see that level taken out, which would then bring this level here into focus of 49.25, which is the April low. So that is pretty much it as far as I'm concerned. I hope you've liked what you've seen. If you do have any questions, then please do just pop them into the questions box. Otherwise, I will see you at the same time next week. Thanks for coming.